Well, I think in the fall of 2020, I disclosed that I had acquired 17,732 Bitcoin, and I haven't sold any. You don't sell your Bitcoin.
Michael Saylor obviously owns a lot of Bitcoin, and this company, MicroStrategy, owns even more. But why owns Michael Saylor so much Bitcoin? This video shows you 3 reasons why he owns so much Bitcoin, and we'll start right now.
The official inflation rate in Argentina is 105%. But that's the official rate, which is that understates it. The actual inflation rate would be higher. And if the inflation rate is running 100%, that means your money is losing half of its value every 12 months. That means that within 10 years, you have nothing. Okay, so bad money, bad currency or bad money loses all of its value over the course of a few years. In Venezuela, you lose all your value in 36 months. In Argentina, in 10 to 20 years, the Argentine peso was 1 to the dollar 21 years ago. If you had $1 million 21 years ago, the Argentine peso right now is about 480 to the dollar. So that's not a 99% loss. That's a 99.8% loss, right?
In how many years?
21 years. Okay, so what I'm saying is you don't have money if you have weak currency. Now let's take strong currency. Well, the strongest currency in the world is the dollar. That's not money. You're losing 99% of your wealth over the course of 90 years in the US dollar, maybe more. The US dollar, the only difference between the US dollar and the peso is whereas it takes 20 years to lose your family's fortune in the peso, it takes about 90 years to lose your family's fortune in the dollar. Right? My house in Miami Beach was $100,000 in 1930. It was appraised at $46 million a few years ago. Do the calculation. It's on a path to be worth $100 million, which means that the US dollar will have lost 99.9% of its value over 100 years. Warren Buffett knows this. Charlie Munger knows this. Basically, the bottom line there is your money in the bank isn't money. Okay, so the answer is you shouldn't have any money in a bank, right? You're basically losing 7% of all your wealth every year in a good year. If it's the dollar, you're losing 15% of your wealth in a not good year. If it's the dollar, you're absolutely losing all your money over the course of a decade. So that's kind of weak money. Awful money is developing world money, the Lebanese pound. The Lebanese pound got devalued. I mean, you would have lost all your money in 5 years if you had the pound. The strongest money, decent money, okay money was gold, but not great. The strongest money in the world is Bitcoin, because Bitcoin is absolutely capped at 21 million. It is global money. You could take $1 billion of Bitcoin across a border. You can transfer it to a counterparty, and no government can interdict that, and nobody can inflate that. And so my answer there would be, you can't trust any bank. You certainly can't trust a bank in Lebanon. Read about Lebanese banks. You can't trust a bank in Africa. You can't trust a bank in Asia.
Michael, but if you call Chase, their customer service is amazing. How was the customer service with Bitcoin when you called the 1-800 number?
There's nobody working at the Bank of Bitcoin to steal your money.
If you do the calculation, the US dollar is being inflated and supplies 7% a year for 100 years. Weak that's the strong currency. That's the world reserve currency is increasing and supply 7%. So the asset inflation rate in dollars is 7% a year over 100 years. That's how you get from $10,000 an acre to $10 million an acre. Now, weak currencies in the developing world are inflating at 14% a year, unless they're really mismanaged and they're inflating at 21% a year. But I'll give you a simple fact. If you start with $1 million and you hold it in dollars and currency that's being inflated and supply at 7% a year, after 100 years, your $1 million is worth about $700. But what do you think it's worth if you're holding it in 14% debasing currencies? 28 cents. Okay, so clearly the weak currencies don't last 100 years because people are smart enough to realize that $1 million going to 28 cents is not a good investment. But the strong currency is taking you from $1 million to $700. And that's the rate in the last 100 years when the US is winning all the wars. We're winning all the wars. So the next 100 years, I don't think it, the question of what's the future of all these currencies in these countries, the euro versus the yuan versus the dollar, I don't think it's really that relevant. I think what's relevant is you just have two choices, or we have three. You either hold your money in the strongest currency in the world, and you're losing 7% a year, you're being cut in half every decade, you're being cut in half 10 times in 100 years, and you're going from $1 million to $700. Or you put your money in the weak currency and you're being cut in half every 3 or 4 years, and you're going from $1 million to 28 cents. Or you put your money into a diversified portfolio of conventional assets, conventional real estate, if you invest in REITs, securitized real estate, or you invest in S&P companies, big companies, you're probably going to grow at 7 or 8% nominally. The money is going to lose 7 or 8% of its value in real terms. And in 100 years, the $1 million of purchasing power you have today will be $1 million in 100 years. You won't have gone bankrupt. You just won't have made anything. So if you want to actually beat that 7% hurdle rate, then you need to strip away the risk and the liability from the asset class. So the risk is your property is seized. The risk is an earthquake hits it. The risk is a flood. The risk is rain. The risk is the executive running the bank steals the money. The risk is the tenant in your building sets it on fire, or they don't pay their rent. The risk is the mayor rent controls your property. The risk is, such and such company, Nokia can't compete with Apple, and BlackBerry can't compete with Google, and such can't compete with AI, or you get unionized. I could give you 100 risks, but the bottom line is the reason that conventional assets like real estate and like stocks, the reason they can't beat Bitcoin is they can't get away from the risk and the liability of having human beings operating a physical property in the real world, because lightning strikes in the real world and governments act in the real world. So Bitcoin is, in my opinion, over 100 years, theoretically in the long run, it's like a 14% versus a 7% monetary inflation rate. Now, if you look backwards, there's a time when Bitcoin was growing 200% a year, then 100% a year. And the last 40 months have been 40 to 50% a year. So clearly it's reasonable for Bitcoin growth to be cooling at some point. But the difference between 14% and 7% is the difference between your $1 million becoming $1 billion. At 14%, your $1 million becomes $1 billion of purchasing power, right? And at 7%, your $1 million stays $1 million, right? So digital property is better than physical property. And that means that you've got trillions and then tens of trillions and then hundreds of trillions of dollars of capital that should flow out of the buildings and the warehouses and the land into the Bitcoin network, because digital property is just better. Lower maintenance, lower tax. You can buy it and sell it in smaller portions. You don't need to be a rich family in London with an army of lawyers in order to buy Bitcoin. A lot of times people think about currencies because of the term cryptocurrency, but I think a more constructive metaphor is to think of it as digital property rather than a digital currency. The use of a currency is as a medium of exchange, and the benefit of a currency is it's a tax-free medium of exchange. So when you make something legal tender in Japan or Russia or China or the US or Europe, it means that you can trade it 100 times a day at high frequency, and all the accounting systems are locked onto that currency, like the euro or the dollar, and there's no taxable event. So companies and governments are always going to want to price things and trade things in the fiat currency as long as there's a government, right? The only time that you're going to use a non-fiat currency for high frequency medium of exchange is when you're in a zone where the currency is literally collapsed. Like if you're in Africa or some war zone and the currency is literally collapsed, there is no government and there is no effective currency, then maybe. But in all the places in the world where the government's functional, the currency is functional. So instead of thinking about that Bitcoin replacing that currency, which it distracts you and it causes you to make all these mental mistakes. Like people go, well, it's only valuable to replace the currency, but it's volatile and it's not built in the accounting system and it's taxable. So therefore it's not going to replace the currency. And so therefore I won't buy it. See, that takes you down a rat hole where you kind of tie yourself in knots in a straitjacket and you come to the wrong conclusion. The right way to think about this is Bitcoin is going to replace all the assets that are currency derivatives, and it's going to replace all of the assets that are weaker properties. So for example, I'm still going to use the dollar to pay my employees, but maybe I won't hold sovereign debt or corporate debt on my balance sheet. Maybe I'll replace the debt with Bitcoin, right? Do I want to wait 30 years and get paid 3 or 4% interest for 30 years? Or do I want to own Bitcoin, which is appreciating at 40% a year and in the extreme will appreciate, say, 14% a year, right? Tax-free or tax deferred. So if you think about it, Bitcoin's replacing bonds. It's not replacing the CNY, the euro, or the USD. It's replacing the bonds that are paying coupons in euros or CNY or USD. And with regard to myself, I'm long Bitcoin, man. like everybody else, I'm wishing I had bought more Bitcoin when it was 9,500 a Bitcoin, right? It's, ultimately, it's the best thing you can do. Let's talk about performance though. For example, since MicroStrategy bought Bitcoin, we entered the market August 10th, 2020. And so what's happened to all these asset classes when you think about diversification? Well, between August 10th and October 31st, when we published our results on our quarterly result with MicroStrategy, then Bitcoin was up 192%. And that works out to a compounded annual growth rate of more than 40%. And the S&P is up 25%.
Mm-hmm.
And the NASDAQ's up 17%. Gold lost 1%. Silver lost 18%. Bonds lost 24%. So in terms of asset classes, Bitcoin is outrunning all of the other conventional asset classes. And if you invested in anything other than maybe Magnificent Seven, you're just not keeping up with inflation. But the Magnificent Seven stocks, if you look at them, while Bitcoin was up 192%, Google was up 68%. Microsoft was up 62%. Apple was up 51%. Meta Group was up 15%. Netflix lost 15%. Amazon lost 15%. So big tech doesn't look like such a good diversification versus Bitcoin, right? If gold was enough to back the currency, the lira wouldn't be crashing right now. Gold is an idea for the 19th century, and it was the best idea for sound money in the 19th century. But in the 21st century, the problem with gold is people keep making more of it. It's just the king commodity, but commodities don't make good money because ultimately the problem with it is you can keep making more of it and the bankers keep rehypothecating it and they print too much paper gold. If you want to defeat both of those defects, you need to make it possible to self-custody and you need to eliminate the creation of more of it. And Bitcoin does both of those things.
So Bitcoin price has gone through quite a roller coaster. What do you think is the high point it's going to hit?
if we look at Bitcoin and model it as digital gold, you know, the market cap goes to between 10 and 20 trillion.
What does that mean in terms of price per coin?
At 500,000, right? That's a $10 trillion asset.
Absolutely.
At 5 million, that's a $100 trillion asset.
So you think it crosses 1 million, it can go even higher?
Yeah, I think it keeps going up forever. I mean, there's no reason it couldn't go to 10 million a coin.